Hi everyone, I'm Ross Bond, a VAT Manager at Francis Clark, and I'm going to talk to you today about VAT. Today I want to raise some awareness over common queries we have received and areas we are expecting to see more of in the coming months, given the current economic climate. I've divided this short talk into three main areas: environmental, social and governance, or ESG, land and property, and business restructuring. In recent years, we have seen businesses respond remarkably to exceptional challenges we have all had to face. Not only have businesses survived through such challenges, but we have also seen some really positive changes. Many have taken the opportunity to rethink their approach to the environment, staff benefits, their use of property, and how their businesses are currently structured. The rising importance of ESG is testament to the work being done to help the environment, local communities, diversity and inclusion. Remote or hybrid working, along with rising overhead costs, has brought into question the use of property and if it is being maximised or is even necessary in some cases. And the challenge of the pandemic has led to some really innovative ideas by businesses and the revision of business plans. With all of the above, we have been involved in some really interesting work and wanted to share with you some of the queries we are seeing and hopefully highlight why that consideration should be taken into account before implementing change rather than addressing issues with VAT after implementation. So as you know, ESG concerns the purpose and impact a business has on the environment and society, as well as considering how robust and transparent its governance is. A focus on ESG allows a business to consider its sustainability and long-term growth, risk mitigation, and how it can support diversity and equal opportunities. We are also seeing signs of the rising importance of ESG through raising of finance, with investors showing a real interest in ESG before choosing where to invest. Consumers are also starting to reconsider who they want to buy their goods and services from. This is often promoted as an accessible way for all to influence change in the way businesses consider their impact on the environment and local communities. There may be opportunities to reduce costs by reducing energy costs through more efficient products or reducing waste and excess packaging. And in what has been a very competitive hiring market for many, we are seeing examples of where ESG considerations have helped provide an edge in recruitment. So what sort of things are we seeing in practice as a result of businesses adopting ESG into their strategies? Electric vehicles. Everyone has seen a real drive in the promotion of electric vehicles in an effort to reduce carbon emissions, including employee benefit schemes. Whilst the purchase or lease of an electric vehicle is treated the same way as a petrol or diesel vehicle for VAT purposes, there are some differences in the treatment of VAT recovery on the cost of fuel. For the avoidance of doubt, hybrid vehicles are treated the same for VAT purposes as petrol or diesel vehicles, depending on which fuel it uses. For electric vehicles, though, there is no option to use fuel scale charges, and VAT recovery will depend on where the vehicle is charged. Where charged at a business premises or public charging port, VAT can be claimed on the business use of the electricity, subject to detailed mileage records. Where charged at home, HMRC are not currently allowing VAT recovery. They are looking to change this, where employers reimburse the cost, but they need to consider how people will be able to obtain evidence to support the cost of the charging and how this can be simplified. Where a business allows employees to charge their electric vehicles at their offices, due to the private use of some of that electricity, this will require the business to either make a charge to the employee and account for VAT on that charge, or they will have to apply a restriction to the VAT recovery on that whole property's electricity cost. If not considered, this could cause a surprise to businesses, and even if the cost is not significant, it does result in an extra complication in the business's VAT compliance. Utilities. We all know the cost of utilities has been rising significantly, but what can be done to try to reduce these costs? One relatively quick and simple action could be to check the VAT invoices you receive from your energy suppliers. VAT on non-domestic energy is subject to VAT at 20%. However, when the amount of energy supplied is low enough, the supply is considered to be treated as a domestic supply, and for that purpose, subject to VAT at 5%. This could represent a cash flow advantage for fully taxable VAT registered businesses or an actual saving for those who aren't able to recover their VAT in full. Additionally, when subject to VAT at 5%, the supply will also be exempt from climate change levy. Again, whilst we may not be talking huge numbers, the amounts can add up over time and across several properties, with the ability to go back to suppliers and request a reclaim of overcharged VAT and climate change levy going back 4 years as well as going forwards. The use is measured monthly for the 5%, so check the use and your VAT invoices regularly. Another popular option is the installation of solar panels. While some suppliers of energy-saving materials or the installation of those materials can qualify for zero rating, including solar panels, this only relates to the installation in residential accommodation, not commercial premises. Even so, many opt for solar panels because they are a renewable energy source. They may reduce energy costs in the long term, and you may also be able to sell back unused energy generated to the grid. When doing so, you will receive feed-in tariff income, which consists of two elements: a generation tariff, which is outside the scope of VAT, and an export tariff, which will have to account for VAT on at 20%. Community projects. Following the pandemic and with the war in Ukraine, there has been a real push for the importance of local community and a desire to help others. Whilst most businesses are used to traditional volunteering activities and charitable donations, care needs to be taken if looking at more regular and significant activities which could fall into the realm of non-business activities. The issue here is that VAT is not recoverable on costs related to non-business activities, and businesses involved in such activities will also need to consider a restriction to VAT incurred on all general overhead costs. Basically, if you're giving your time, money, or assets to the community or a charity and not receiving anything in exchange, you need to consider the potential impact this could have on your VAT recovery position. When making donations, if you receive anything other than a trivial benefit in return, you may be seen as paying consideration for a supply, and the recipient may need to account for VAT on the amounts received. When offering something for free and in exchange you receive a non-monetary benefit, such as goods or services, there could be a barter transaction, resulting in VAT becoming due on either your supplies, theirs, or both. Where goods with a value not exceeding £50 are gifted to the same person in the same year for a business purpose, a business may reclaim the VAT incurred without having to account for VAT on a deemed disposal. However, if this is done for a non-business purpose, you may end up having to account for VAT as if those goods had been sold. Hopefully, you can see from the above that some straightforward changes can lead to some unexpected and undesired VAT costs or complications. As I mentioned earlier, with the introduction and growing adoption of remote or hybrid working, we have seen businesses having to reconsider how they are using property, especially given the rising overhead costs. Some have looked at downsizing and maybe looking to end leases or sell property. Others have re-evaluated how best to use excess space that is no longer being used by their staff. Do they sublet those premises? And have they considered VAT implications of such changes? In very general terms, most suppliers of land and property are exempt from VAT by default. However, there are exceptions to this, such as the supplies of car parking or the storage of goods. Additionally, businesses in certain circumstances can opt to tax non-residential property and charge VAT on supplies of that property. When VAT is incurred on land or property, the recovery of that VAT is driven by the use or intended use of the premises. And because land or property tends to be a high-value, long-term capital investment, HMRC are interested not only in the immediate use of the property, but also how that use may change over the life of the asset, particularly where VAT is incurred on significant property costs. The asset may fall within what is called the capital goods scheme, and the use of that asset will need to be monitored over a 10-year period with an adjustment to any VAT originally claimed, if there is a change of use, or if the asset is disposed of. When buying a property or entering into a lease, one of the first questions that should be asked is whether VAT will be due on the purchase or the rent, and if so, why. VAT is due on the purchase of new commercial property, as well as both the purchase and letting of opted commercial property. If VAT is being charged because of an option to tax, ask for a copy of the vendor's option and, where possible, HMRC's acknowledgement or receipt of that option. This not only supports the validity of the option to tax, but also confirms the effective date of the option. If the property was opted within the last 6 months or over 20 years ago, it may be possible to request the vendor to revoke their option, making the sale or rent exempt from VAT. If the vendor's option cannot be revoked, it may be possible to disapply the option if, say, the property will be converted into residential. Alternatively, if the property is let and will be acquired with the benefit of a tenant in situ, or you will be acquiring the business as well as the property which you will continue to run, the purchase may qualify as a transfer of a business as a going concern, or TOGC, and outside the scope of VAT. TOGC treatment is compulsory but requires a number of conditions to be met. We are finding solicitors are referring questions around TOGC treatment to VAT advisors more and more, given the complexities, change in HMRC processes for options to tax, and challenges from HMRC on the correct treatment of transfers. And we are always happy to help clarify the VAT treatment of such transactions and liaise with solicitors to avoid VAT becoming due, where the transfer could be structured to ensure those conditions are met and the supply is outside the scope of VAT. This can not only aid cash flow, but it could also result in savings if the VAT would be irrecoverable, or because stamp duty land tax is charged on the VAT inclusive value. If you are incurring VAT on rent but are subletting the property, it does not necessarily mean that the income from the subletting will also be subject to VAT. Instead, you need to check the VAT treatment of your own supplies, and although your landlord may have opted to tax, that only covers their supplies of the property. Should you wish to charge VAT on the subletting, you may also need to opt to tax the property yourself. You may also need to consider the VAT treatment of any recharges or service charges to your tenants, the VAT treatment of which may follow the VAT treatment of the rent. It may be considered a separate supply, such as separately metered gas and electricity, or could be outside the scope of VAT as a disbursement. What about when a business changes their use of a property? For VAT that was reclaimed on a capital goods scheme asset, as mentioned earlier, any change in use within a 10-year period from first use may result in an additional claim or a clawback of VAT originally incurred. If the land or property is not a capital goods scheme asset, you only need to consider the use of the asset within the VAT year. For example, if you submit VAT returns on a calendar quarterly basis, you only need to consider a change of use between the 1st of April and the following 31st of March. If use remains the same, no adjustments will be required. But again, if there is a change in the taxable, exempt, or non-business activity, an adjustment will be required. There will, of course, also be the consideration for the recovery of VAT on ongoing revenue costs and capital expenditure in the future. When selling land or property, similar considerations should be taken as to when purchasing. However, as the seller, you are responsible for the VAT treatment of the sale. The purchaser's solicitors or their advisors are likely to ask questions around TOGCs and options to tax. They may also request copies of your option and HMRC's receipt of that option. If you didn't hold a copy of HMRC's receipt or acknowledgement of your option to tax, HMRC used to provide these upon request. However, they will no longer provide these if the option was notified within the last 6 years, as you should have retained these records. So extra care needs to be taken to ensure that you do retain records on opted property. If selling a capital goods scheme asset, you could end up with a clawback of some of the VAT claimed if the property is exempt on sale. This may be avoidable with careful consideration depending on the circumstances, and you should check the position at an early stage to ensure your pricing allows for any unexpected VAT costs on the sale. On the ending of a lease, you may be charged for dilapidations. These are outside the scope of VAT, but you should check the wording of your lease carefully, because if dilapidations are not covered in that lease, HMRC could challenge whether the payment should be subject to VAT. Additionally, if you have made any improvements to the property before lease, you may incur costs in returning the property to its original condition, or be seen as making a supply of construction services or goods to the landlord, which may be subject to VAT. Again, the wording held within leases will be important in determining the VAT position. Complications may also arise where businesses decide a lease is too onerous and either pays a third party to take on the lease under a lease assignment or pays their landlord to surrender the lease. Payment of a lease assignment premium is considered a supply for VAT purposes and subject to VAT. Businesses may seek advice on their structure for many reasons. Perhaps they are seeking to improve efficiencies and reduce cost, share resources, or obtain tax benefits. There may be changes due to the future planning for succession or retirement, or they may be looking to sell all or parts of a business to extract profit. There may be a risk mitigation motive if setting up new business activities that may be higher risk and might want to carve out or ring-fence these to protect the existing business. I won't address the VAT considerations on all of these, as I would be here all day, and I am sure not even the most keen VAT enthusiasts in the room would wish for that. I just wanted to touch on some of the often overlooked areas and some topical issues we are seeing. Intercompany supplies. Quite often, we will see intercompany supplies within group structures through intercompany accounts in the balance sheet without considering VAT. When this occurs, not only does the VAT treatment of a supply need to be considered, but also the timing of when any VAT due needs to be accounted for. For a supply of goods or services, the basic tax point rules apply, but for a continuous supply of services, this may be when the accounts are signed off, or after 12 months have passed in certain circumstances. Common examples we see include supplies of staff. Usually, the supply of staff will be subject to VAT at 20%. However, it is important to consider contractual arrangements and the wording of agreements to understand whether there is a supply of staff for a VAT purpose or a supply of services, as the VAT treatment may differ. If supplies of staff, it may be worth looking into the possibility of joint contracts of employment or common directors, which would avoid a VAT charge on supplies. Although legal advice should be sought for such arrangements. Supplies of finance. Interest-bearing loans could be seen as an exempt supply, whereas non-interest-bearing loans could be seen as a non-business activity. Both could affect a business's input VAT recovery, but each has different considerations. Alternatively, simply paying something on someone else's behalf may be treated as a disbursement and outside the scope of VAT. But in these circumstances, it is important to understand who the supplies are being made to, and that invoices are correctly addressed to avoid irrecoverable VAT costs, which may have been avoidable. When restructuring, you may transfer businesses or parts of businesses into other entities. However, if you are merely transferring assets, this is likely to be seen as a supply for VAT purposes and can result in VAT being due on the consideration paid. If no consideration is paid, VAT may still be due on the value of the assets transferred. This is particularly relevant where values are large or land and property is involved, and the gift rules will need to be considered. In such cases, output VAT may become due even though there is no consideration, in which case the donor cannot raise a VAT invoice, but could issue a tax certificate allowing the recipient to recover the VAT if the goods will be put to business use. Land and property. I have already talked about land and property considerations, but just remember when moving around property within group structures, do not forget to consider the impact of options to tax, the timings and conditions for a TAGC, and capital goods scheme adjustments. There can also be complications where transfers are structured via dividend in specie, as these are deemed to fall within the gift rules I just mentioned. It is worth remembering that the supply could be exempt from VAT, but this could cause issues of VAT recovery on associated costs or clawbacks of input tax previously claimed. HMRC delays. Finally, one very relevant topic currently is the impact of HMRC delays. Following the close down of several physical offices and redundancies at HMRC over recent years, exacerbated by the issues of COVID and Brexit, HMRC have experienced severe staffing issues, leading to delays, particularly noticeable in VAT departments. HMRC have hired new staff, but these are untrained, and with the introduction of MTD for VAT, the new VAT registration processes, HMRC systems, and the new VAT penalty regime introduced this year, combined with internal issues of security and data handling, we have seen no end of problems with HMRC processing straightforward registration requests, group registrations or variations, and change of legal entity requests. All of these may be essential to structuring arrangements and can have a huge impact on the timing of transactions, cash flow, or VAT recovery. VAT is complex, and changes in business activities or structures, no matter how subtle, can cause undesired and unexpected results, especially where land and property is concerned. Given the current climate and the way people are working, the increase in costs on businesses, and the actions being taken to attract potential employees can all have VAT consequences, and it is best to figure these out or ask for advice on these matters before implementation rather than after.